Welcome to the Stockouts. This is your show at FreightWaves for all things related to the CPG industry. I'm your host, Mike Bowdendistel. I'm the head of intermodal solutions here at FreightWaves. And for those not familiar with FreightWaves, we are the largest media and data provider that's focused on freight transportation and logistics and supply chains. And today, I think it'll be a really interesting discussion. I'm going to have two guests on from a company called Vorto. Vorto is an AI-based platform that automates shippers' supply chains across procurement, logistics, and carriers. They're also making a big push into retail and CPG after getting their start in the energy industry. So just lots of really topical, subject matter there. I was just listening to the Kellogg, analyst call, and they were talking about using, AI to, better predict, consumers' behavior, enabling them to leverage the data that they have for targeted promotions, things of that nature. So just really hot topic, anything related to AI. Everyone's trying to figure that out right now. So I'll do that, and I'll talk a little bit about the CPG earnings season. I think sort of the big theme there is that most CPG companies are performing well and better than expectations, with the exception of maybe the meat packers, which I'll talk about. Tyson, which reported this morning. Go through that a little bit. But before I do those things, would invite anyone who's not already signed up for the CPG newsletter that I do to go ahead and do that. Anyone who's interested in just consumer packaged goods, supply chains, and freight transportation, you can do that pretty easily. Go to freightwaves.com/the stockout, and would encourage you to do a lot of those other newsletters as well. A lot of good information that we put out on a weekly basis. Try to send that out every Wednesday at 2:00 Eastern. And the other sort of quick advertisement I give here is I'd highlight our next month's Future of Supply Chain event. So this is a big FreightWaves conference that we have. And, we have two big conferences every year. This one is going to be in Cleveland. As you can see on the graphic there, it's going to be at the Rock and Roll Hall of Fame, June 21st through 23rd. Have a great lineup of speakers there. I'll probably be at the Sonar booth talking about our data product, Sonar. And so hopefully to see some members of the Stockout community, at that conference. And so with that, go into today's news topic. I'll try to make this brief so we can save time for the discussion here with Vorto. But really, sort of the big news item today is Tyson shares under a significant amount of pressure. They're down 15%. So this is the second worst performing stock in the S&P 500 today. You can see that drop off there at the right column, down almost $10. And you see it's been a round trip during the pandemic, going from 60 to 100, now down to $50.93. And so they reported today, second quarter profitability weaker than expected. Adjusted earnings was a 4-cent loss after posting EPS of $2.29 a year ago period. They cut guidance. Sales guidance went from 3 to 7% growth to 0 to 1% growth, and then margins in the various guidance in the various segments were cut anywhere from 200 to 300 basis points, with the exception of the branded products that are basically the processed food. Those are not being changed. So this is kind of the one, I think, sector of CPG that's not doing as well, and part of that is because it's a difficult comparison, because meat was doing so well during the pandemic. Now consumers are cutting back on the higher cuts of meat, even if they don't seem to be doing that for other types of packaged goods. Some other highlights here: volume up 3.3%, and an average sales price was down 3.2%. So actually seeing some inflation, deflation in the price of meat. So that's at least a good thing for consumers, and really sort of the issue that Tyson's having is that it's rising costs to purchase live cattle, live hogs. Their input costs rising. So really sort of the reverse of the market dynamics. In the early days of the pandemic, when they were able to buy those animals at really attractive prices, and you probably saw the news last week. They're cutting 10% of the corporate positions, including 15% of the corporate leadership positions, all at the same time that they're trying to automate the sort of the frontline hourly workers. So it kind of highlights, and I think the CPG industry and in the economy overall, the mismatch between education levels and maybe skill levels and the positions that are needed. So that's one I'll write up for the newsletter this week, and then just want to highlight quickly one sonar chart, if we can get that on the screen. So what this shows is dry van contract rates in white, excluding fuel, and then the spot rates, the dry van spot rates in orange, with an algorithm to remove fuel. And it shows that the contract rates, let's call it close to 75 cents above the spot rates. And I've made the argument in other written material that the CPG companies are not trying to wring every dollar out of the supply chain right now. I mean, they could be more aggressive if they wanted to, but it seems to me that really they're prioritizing service, prioritizing building relationships with carriers under the theory that if they take care of their carriers now in a loose freight market, when things eventually turn, the carriers will take care of them. Their tenders will not be rejected. Well, at least not be the first to be rejected. So that's, to me, seems to be the approach that a lot of these big shippers that need lots of capacity are taking, which also speaks to how the larger, trucking companies are doing better than the smaller trucking companies. So with that as a little bit of a overview of what's happening in the CPG industry, we'd like to bring on today's guests. We have two guests from Vorto. Thank you, gentlemen, for joining me. First, I have Prayesh Ranjan, CEO of Vorto. Thanks for being here. And Ramesh Chakala, who's a strategic advisor to Vorto. He also spent 11 years as a senior vice president of global supply chain at Walmart, so a tremendous amount of experience there. Thank you both for joining me.
Thanks for having us.
My pleasure.
Yeah, so just to get started, why don't you give us a little bit of just an overview of Vorto, who the typical customers are, sort of what you're hoping to accomplish there, maybe how the business got started. We'll be interested in all of those things.
Just some background, I think the company started in 2015, before my time, and we used to be a TMS software company at the time. And one of the things we started noticing that there was a lot of challenges in visibility between three parties, and that was shippers, suppliers who provided different products, as well as carriers. So Vorto actually revamped its complete offering and developed a complete autonomous supply chain platform where we automated all the way from predicting the demand signal for the shippers to providing forecasts for the products to the suppliers, all the way down to dispatching the driver at the trucking company. So that created an end-to-end integration with regards to managing the demand signal, managing the inventory and the working capital of the shipper, managing the utilization of the suppliers who were trying to have that knowledge of what is needed in the future, all the way down to maximizing the driver efficiency for the carrier. So that's basically what the platform does. We work in the energy sector, so a lot of large energy service companies are on the platform that move a very large amount of products, SKUs, and freight. Since then, we have also expanded into this consumer products good industry, mostly retail and grocery, as well as the drayage industry, which is mostly at the ports. So those are our three main markets that we are really focused on.
Mm-hmm. Yeah, so how has that transition been? I mean, I would imagine those really have different, drivers. Energy industry, looking at oil prices and those things, and then consumer goods, not as volatile, but sort of looking at inventory levels and all those things. Like, what are some of the inputs that go into that predictive methodology?
The most common thread we see across all three industries are basically three common problems. Everybody is trying to solve for on-time performance with regards to making sure they don't stock out. The second problem every shipper is trying to figure out is how to hold just the right amount of inventory to reduce their working capital. And then the third thing that most of them are always trying to figure out is, as you know, the freight industry is incredibly cyclical. So you get the tightness and looseness, some of the things that you were alluding to early on, where how can you build platforms where you can drive efficiency irrespective of whether it being a tight market or a loose market. So this common thread has been across pretty much everybody, every shipper across all three industries. They want to reduce their freight cost, reduce their working capital, and not have stockouts. And The way we have gone about building the platform is we plug into the demand signal for the shipper. So the software predicts, all the SKUs that are needed. It automatically sources that from their network of suppliers. So it cuts the POs, it schedules the appointment times all the way for their warehouses, the suppliers' warehouses. And then it goes end to end where the trucker gets dispatched and you have that end-to-end visibility on when the trucker will show up, pick up that product, deliver it, and the inventory will go back up. The trucking platform is an extension of Vorto. It's called 5F, where we have aggregated owner-operators and created a freight platform by plugging them into this what we call shipper pooling. So it creates efficiencies for the shipper as well as for the trucker. As you know, majority of the shippers are incredibly small in America within the $800 billion of freight, where they're not able to create enough efficiencies with their own volume for these truckers. So by using AI to pool the shippers and pool the truckers, we've been able to create a win-win where we are reducing the working capital for the shipper, not letting them have stockouts, having a lower freight cost, and on the other side, increasing the efficiency for the trucker, having a higher earnings for the trucker. So it creates a win-win for all parties.
Mm-hmm. Yeah, that's interesting. So it's basically there's this inefficiency in the marketplace that you're trying to solve for, which is, I guess, the big reason why the truck brokerage industry is as big. So is that sort of your thought on the market overall? Is that as the years go by, more of the truck brokerage automation, which still to a large extent takes place over the phone, a lot of that will be sort of automated away?
So I'll answer that in two points. When we entered the space and we looked at the freight volatility, which is the market getting oversupplied, undersupplied, and trying to figure out how do you create stability, we actually learned something completely different. We realized that the volatility actually doesn't happen with the shipper-carrier relationship. The volatility actually happens at the driver level. So it's the driver that quits and plays musical chairs across carriers. So that's why you have 94% churn, right? So I may be a carrier, may have a very good relationship with the shipper, but the person that quits and creates the volatility is the driver because of lack of consistent work, lack of consistent efficiencies. So one of the things we noticed is a lot of the relationships in our between brokers and carriers in covering freight is very transactional. It's not really solving the root cause of maximizing the efficiency for the truck and maximizing the efficiency for the driver, the main person that actually does the trucking. So I don't know, where the brokerage and the carrier industry will move, but I know one thing for a fact that as we are bringing in technology, and many other companies are bringing in technology, a lot of them are going to really get really focused on maximizing the efficiency to reduce the empty miles, to reduce the idle time between shipments for these truckers, and that transactional relationship will start going away. Will that need automation? 100%. Today, we move very large amount of freight and with zero interactions. There is no phone calls being picked up. There's no negotiations happening, because as soon as you start adding those levels of inefficiencies in the system, all that noise kicks in and the driver gets inefficient. So I absolutely believe that connection of freight to the end trucker will be several times more automated than what it has been for the last 2 decades in America.
Maybe I can just add a couple of comments, Mike, is, being in this retail and supply chain business for close to 3 decades, what we have always seen is whenever we plan our trucks, plan our carriers, plan our workflow, it's always been a static environment where, you have a lot of data inputs, and based on the data inputs, you plan your truck, you plan your schedule and everything. With the complexity of supply chain that is really been increasing with e-commerce and multiple data inputs, the need of the hour, I feel, is more dynamic and real-time activity compared to the static way of doing business. That's what I think is the big difference with automation is it helps with the dynamic, more real-time, it takes all this, multiple variables, tens and hundreds of variables in a more real time and optimizes and creates that efficiency that has always been a problem. Because at the end of the day, when you look at the whole transportation side, you have a lot of empty miles, a lot of opportunities on reducing the take rate or the brokerage commission fees, etc. On and then still utilization of the assets and the resources is not the best. So that's what I feel the automation is going to help at the end of the day is optimizing all these multiple variables in a very dynamic, real-time manner to Priyesh's point of going after all three, which is, reducing cost, increasing sales with less out of stocks and reducing working capital. The inventory is still a big issue, even after the pandemic. So that's what I feel is going to be a huge help by automating the whole process that Priyesh kind of talked to. And that's the reason you'll have more strategic relationships, I feel. Transaction relationships we've been having for decades. The need of the hour is more strategic relationships.
Yeah, that makes a lot of sense. I just wanted to ask you, have you noticed a lot of the big, companies, big shippers, more willing to invest in these type of technologies here in the last, let's say, few years? Because I know at least the CPG companies have said, well, these challenges have been sort of unprecedented. It was like, you think about like Kraft Heinz saying at any given day, we either don't have some ingredient we need or we don't have some piece of packaging we need. And it's like, I guess the idea with your system to a large extent is to sort of get ahead of some of those problems, to sort of figure them out ahead of time.
So I think, I'll let Ramesh elaborate, but kind of where we saw a lot of openness towards solving these three problems was during the COVID disruptions. And it started uncovering this dynamic nature of supply chain, right? To his point, everything was done in a very static environment with regards to how supplier networks are managed, with regards to how freight is managed. And there are certain things you can predict, and then there are certain things in supply chain you just need to react incredibly fast. Technology and software allows you to react in a matter of seconds, whereas manual processes makes you react in weeks, sometimes months, right? And that has stockouts, that has sales impact. So there has definitely been a lot more awareness in the shipper community with CPG, energy, as well as the drayage, import-export markets, where people realize that software allows you to react faster to disruptions. Sometimes I sit down and I think about it, is how much can you predict and how much can you react? The more we have learned over the last 5 years with this platform is you can build a system across two statements. One is predict certain things, and second is react incredibly fast. And because supply chain is so dynamic and there are so many moving variables, what we are noticing is that you're better off reacting incredibly fast because a lot of things cannot be predicted. And software plays a really powerful game there, from changing the demand signal to rescheduling procurement, to rescheduling appointment times, to figuring out which carrier, which trucker needs to deliver this load. And all of that stuff we do in matters of microseconds on the platform. It gets operationalized end-to-end through automation. And that has kind of been kind of the biggest awareness on why technology is valuable relative to how it was done in the past. I'll let Ramesh give his perspective from a retailer's perspective as well.
Yeah, just one comment on that. The advantage of the AI really helps create the learning layer, right? You keep learning from the problem each time, and when you keep learning from the problem each time, your algorithms get better and your errors become less and more predictability gets better. So that's what really is attractive when I've seen this company the last couple of months is that's something that has been missing in the whole retail and CPG industry is that continuous learning layer with AI automation that will help optimize the efficiencies you need across all angles. So that's something that is going to be a huge help, I feel. And it could be an inflection point. It's similar to how things happen with share ride scenarios, right? The whole industry has gotten become different the last 10, 15 years. Same thing with this, I feel, in the next several years as well.
Yeah, you bring up a lot of good points. How you have to react quickly to change things that are unexpected, and then learn from all these things that have just taken place. So you don't repeat the same mistakes. Ramesh, I want to ask you about just you have such great experience in retail. I mean, what can a CPG company do to keep their retail partners happy, avoid on time and full fees, and what changes do you see taking place in terms of retail supply chains?
Yeah, yeah. So when you look at, it's almost like a three-legged stool, right, Mike? When you think about, or four maybe, is when you have the suppliers, which are basically the manufacturing, the CPG companies, the retailers. Then you have all kinds of assets everywhere, and you have resources, the drivers. So, when you take all these four pieces, and we know all the problems that we have had with, equipment availability, the assets availability, the utilization of it, the driver turnover, all that stuff, right? And then, product not being on the shelf for the shippers. Uh, I feel that more and more as you move forward, you're going to take a lot of this middle layers out. I think the time has come for the some of this brokerage, the middle layers uh, you know to be taken out and cut through those pieces out and optimize the whole supply chain. I see that happening in the next few years, where it's going to be the ecosystem partnership and relationship is going to change. I feel because of the technology utilization, the digitalization, the automation. That's where it's going to play a huge role, and that's what I was talking earlier on. The dynamic, the real time, all that activity will really can be a sea change on reducing cost significantly if we really leverage that. Well, example, Mike, is if you look at the overall transportation, you probably have all kinds of data. The empty miles of the deadhead is pretty high. Even for
Mhm.
big companies, without naming any specific data of any company, but the empty miles of deadhead is very high. So as the supply chain gets more complex, you have more middle mile, you have more last mile. There's more activity over there. There's a need for the supply chain efficiency to happen because most of the majority of the e-commerce companies do not make money, are not profitable. So this is what I feel is going to help, especially on the short hauls, as you because the biggest expense for e-commerce is the short hauls. The last mile. That's where the efficiency can kick in, and you cut down all this middle people and have more automation that can have a significant 20-30% plus impact in reducing costs if we really implement these type of platforms with the right people and process aspects as well. I don't know if I answered your question, Mike.
No, I think that makes a lot of sense. Yeah. I mean, I do wonder more technologies like this, take place based on all you're describing. It almost makes it seem like the playing field be more level for the small trucking companies, because large trucking companies have enough scale that they have someone they can dispatch to get the backhaul. They don't have to rely on a brokered load that's not going to pay very much. So you're reducing those inefficiencies. Sounds like to me that would help the smaller carriers more than it would help the larger carriers. So I think that's interesting. I wanted to ask you about, you have some interesting statistics on your website about the environmental impact of eliminating a lot of these empty
Yeah.
miles, out
Hey,
of
Mike,
route miles.
can I add one comment over here very quickly because
Sure, please. Mhm.
you mentioned about making an impact on all the small truckers and drivers and all. You know, coming out of working at big corporations, I also feel that a lot of these companies have private fleets which are not utilized really well. So
Mhm.
the advantage you'll get is, those companies will have an advantage of working with this type of platforms to have a better ecosystem partnerships with the suppliers as well,
Mhm.
because they don't
Mhm.
have the data points for everything. Now, if you get on with this platform, and then, for example, you have the outbound. When your truck comes back from the store, you want to optimize it, right? Now we have, if you work with these type of platforms, then you have better opportunity of hooking up with multiple suppliers because you have so much more intelligence. So only thing I'll differ with you is, those bigger corporations also have underutilized assets and less control of supply chain. So this will help have a better ecosystem partnership and utilize their assets a lot more better than what it is today.
Yeah, that's a good point. I mean, we shouldn't forget that these companies have private fleets. Those are expensive assets. They have a hard time recruiting drivers, also, that can have a big, impact to their supply chains as well. Maybe just our last question to wrap it up. Can you talk a little bit about the environmental impact that companies like yours can have? I know a lot of these CPG companies really care about their carbon footprint. Some are actually starting to put like the carbon label, almost like a nutrition label of how much carbon impact it is. So I don't think that trend's going to go away, but maybe talk a little bit about that.
Yeah, so I think obviously in the freight industry, the simplest way to quantify that is reduction of empty miles and idle time, and that's been a very big topic with CPG companies. In fact, there are a lot of these different companies that do accreditations with regards to the carbon footprint impact. In fact, I think we are going through right now one with NASDAQ, and that's it's a very important component on their messaging to their investors, to Wall Street, as well as them being able to clearly demonstrate tangibly on how are they achieving those goals across their different aspects of their value chain. That may be through manufacturing, it may be through freight, it may be through all of the above, right? So that's definitely been a very hot topic, especially in the CPG industry. I don't think we have a single customer that has never asked us for a report like that. So totally agree. It's a pretty big topic, and a few things to just kind of that we have seen as a learning is oftentimes the thought process is efficiencies are driven by reducing empty miles. As you start looking at short haul, medium haul, long haul networks, you'll start realizing that the carbon footprint impact comes from different aspects, from reducing idle time, maximizing the truck. And one of the things we are starting to notice very clearly and very quickly is all the volatility that happens in the trucking industry happens at the driver level. 96% of America's trucking are small fleets, less than 20 trucks. So technically, that's the main market, or where freight actually truly moves. A very large amount of freight moves, and almost all shippers, all carriers, do not have enough volume to drive that level of efficiency. I mean, whether that's a large carrier or whether that's a large shipper, their volumes are minuscule in an $800 billion of freight across America. So one of the things that we are really focused on is pooling shippers, pooling truckers, and creating that efficiency across both sides of the marketplace. And that has started to really have a very large impact from a carbon footprint perspective, and obviously from a freight cost perspective and sustainability perspective. But it's incredibly important to look at this from a holistic view than what a single truck is doing within a carrier base or a private fleet. So that pooling has become one of the main components of what we are trying to solve for, and then obviously have a sustainable environmental impact doing that.
Yeah, that makes a lot of sense. I think there's a lot to improve in terms of efficiency there, on both sides of the market. Unfortunately, this is all the time we have for today. But thanks so much for joining me. And how can people reach out to you and reach out and learn more about Vorto?
I mean, they can reach out on our website. There is a way to contact us. So please feel free to reach out to us, and hopefully we are making a positive impact in the industry, and look forward to the coming years with regards to all the transformation we're trying to drive in the CPG industry.
Great. Well, best of luck with it. We'll be watching, and wish you all the best. Thank you.